The markets pushing toward a strong finish for the year. Our next guest says the rally is being fueled by AI FOMO, or fear of missing out. Also, optimism around future rate cuts and resilient consumer spending, despite some affordability stress. Joining us now, Matt Rowe, Man Group Managing Director of Solutions. Matt, good to see you.
Good to see you.
We have global equity markets at highs. We have stock and bond volatility at lows. Corporate credit spreads are pretty benign. Market sending a signal that I guess the global fundamentals look okay. Do you take issue with that into next year?
Yeah, I think the global fundamentals don't look disastrous. I think the theme for 2026 is going to be that there's a have and a have-not story that will play out. And we've seen dispersion in the market among equities and among factors, but I think globally we're going to see different economies perform differently. I think we're going to see a separation from the everything rally, and we're going to see more differentiation.
In what direction would that differentiation?
Well, I think you've got non-uniform fiscal policy, non-uniform monetary policy. Interest rates are coming down in certain parts of the world and going up in others. Cost of capital is going to be something that people are actually newly sensitive to, I think, in this coming year. But it's really played out pretty well with the AI story and the CapEx that we've seen there. And
so the outperformance of non-U.S. markets this year has really, it looks great on a one-year basis. On a 5-year, it kind of doesn't look like much.
Right.
So how do we think about that going into next year?
There's been a lot of discussion around de-dollarization, and I don't want to say that people are abandoning U.S. markets. They're not, throwing American exceptionalism in the trash can. But there is an attitude towards diversifying to different markets, specifically European defense spending, and policy in general there is driving a lot of constructive narratives, along with current valuations of U.S. equities. And to me, it feels a lot like the late 90s when I was watching this show, sitting on the floor of the Pacific Exchange and seeing many different tech companies booming and
literally sitting on the floor.
Now?
No. Oh, you mean on the floor?
Yeah,
okay.
I was working on the Pacific
You can get
Exchange.
a chair, right? You can.
Yeah, if you sat down, you didn't stay there very long.
Yeah.
But it was a time where people would buy a little bit of 100 different things, and if 2 of them hit, the whole portfolio paid off. It feels that way in AI right now.
What do you make of the move in precious metals? I saw that you think gold is a little over its skis at this point.
Yeah, look, 4,000 years of data is relevant on one hand and irrelevant on another. If you look back that far, the ratio of gold to silver is roughly 10 to 1. We're at, this morning, I think something like 70 to 1. The stretch of the rally in gold is pulling up the rest of the metal complex in a relative value framework. So I think silver is the most directly aligned. There's an argument that platinum might be the best industrial replacement for silver, and it trades at half, I think, of what gold trades today. So there's a real relative value play there. I think it's a really interesting thing to watch globally because gold plays many different roles. It plays an inflation defense role, which is arguably, not as effective as people like to say it is. It also plays a sort of global diversification role. So when you see people pushing into gold to the degree that they are, I think they're worried about inflation. I think they want to be sort of fluid from a currency exposure perspective. And they are seeing a lack of other things to place their money in. So it's sort of an under the mattress, if you will, trade.
So what do you think kind of shifts that narrative and shifts the direction of gold as well as silver, which sounds like more of a beta play on gold in many respects?
Yeah, I think once you see a little more certainty around the global framework, right? I think people aren't super excited about buying equities in the U.S. because of the valuation, but they feel like they're forced to remain invested. Nobody in our business gets paid to sit in cash, right? So we need to find in the business and broadly needs to find ways to remain constructively invested. And I think gold has been a tremendous story this year, and so too have all of the metals. So it's really worked out well. I personally would rather own a ratio of platinum and silver, even at today's prices, to being long gold. But I think, look, the easiest way to get in trouble with your boss or your clients is to not be exposed to things that go up over 100%.